BlackRock launched an ETF way back at the beginning of the year. The things that BlackRock has been doing have been changing minds. Jerome Powell, the Fed chair, actually described Bitcoin as being like digital gold. Having anybody in his position say something like that would have been mind-blowing, would have been absolutely crazy.
It becomes something that people believe in and realize it's not going away. But we go through these cycles, and it's good to celebrate the cycle that we're in now. All right, Simon, we've got a fun one for today. I have a question for you. We've got two things that are back in the cultural mainstream. One is the McRib, and two, Bitcoin's now over 100K, so everyone's talking about it. My question for you is, what pushed Bitcoin over 100K? Was it the McRib being reannounced by McDonald's, or a bunch of new appointments, or something else entirely?
I want to say it's the McRib. The correlation is not causation. Sadly, it may be a tasty correlation. I'll have to try that for myself and find out. I've never had a McRib. But no, the narrative driving this is without question Paul Atkins' nomination as the new SEC chair by the Trump administration. So Paul Atkins has been a long-standing advocate for crypto and Bitcoin. He was on the board of the Digital Chamber of Commerce and is kind of a bit of a Washington insider, very well regarded in DC. But of course, the Securities and Exchange Commission of Gary Gensler was a little bit less receptive to crypto. Famously, they've sued Coinbase, they've sued Ripple, they've been really, really pushing a lot of enforcement actions on the industry and kind of refusing to support any...
We won't tell you what the rules are, but you're definitely breaking them.
Yeah, well, so the argument the SEC had was like, hey, we've told you what the rules are. It's the Howey test and everything's a security. And like, that wasn't necessarily something that the rest of the market really, really agreed with. So, that caused some issues. So that's narrative number one. But I think that the more interesting narrative of why 100K and why now is the much bigger zoomed out picture that this was going to happen inevitably anyways. BlackRock launched an ETF way back at the beginning of the year in 2024, and that really just unlocked a lot of institutional capital, and the things that BlackRock has been doing have been changing minds. So famous critics like Ken Griffin, who's the president of Citadel Securities, has said quite recently, actually, I wish I got into Bitcoin a little bit earlier. And people are now seeing it quite differently. It's gone from being like that naughty teenager to kind of a little bit more grown up. And I think that coming of age of Bitcoin now suddenly doesn't seem that wild and doesn't seem that weird. I don't know if you've seen the same thing. But the other thing I saw was Jerome Powell, the Fed chair, actually described Bitcoin as being like digital gold. Now, he was clearly distancing Bitcoin from the US dollar in doing that. But again, 5 years ago, having anybody in his position say something like that would have been mind-blowing, would have been absolutely crazy, because this is back when Bitcoin was just for anti-money laundering. It was only used by criminals, like it was going to be terrible, terrible, terrible. And now the reality is really quite different. So that's a big narrative shift, number one. Well, what do you think? I mean, you're kind of more on the tech world view of this, right? Like, and crypto was all the rage. We were talking about metaverse. Everything in tech was crypto, and then it kind of went away. So what do you think's driving the momentum in this space?
Well, I agree with what you said. And first, I'm also excited that you guys are talking about Bitcoin over in the UK, because it's only 83,000 pounds right now. So I wasn't sure if this was just going to be an American audience topic that resonates. But yeah, so you talked about the kind of immediate effect about what's going on now. One is regulatory regime change, ongoing. Of course, we had the election, but also now we know who the new SEC chair is. And then just kind of the slow, steady chug of institutional adoption. You mentioned the first Bitcoin ETF earlier this year. That was the first Bitcoin spot ETF because the SEC was trying to claim purview over Bitcoin, but they couldn't claim purview over futures. So there were Bitcoin ETFs, but they were based on futures contracts, which are like worse for various reasons. But now we actually have something that's like pretty close to as good as just holding the thing directly yourself through Coinbase. But But you pointed out, and this is probably the kind of the non-story, it's that the Satoshi's white paper was published in 2008. Bitcoin's now been around for 16 years. Every time Bitcoin drips back into the public consciousness like this, it just reinforces it. And it becomes something that people believe in and realize it's not going away. And then slowly it becomes like digital gold. Now we've been using gold for about 4,000 years or more. And Bitcoin's new, but it has a lot of good affordances that gold doesn't. And so here we are.
Well, so here's the wild thing about the fiat monetary system is that only works because people believe it. Same with the legal system. It doesn't hurt that sovereign governments have lots of people who believe in them, and those sovereign governments are able to direct militaries, and they have real, actual might. That's very, very powerful and very, very useful. But Ray Dalio has a concept called the 70-year debt cycle, if you've been following his work, of Bridgewater Associates, a famous investor. And that 70-year debt cycle says, every 70 years or so, we go through this major change in how our monetary system works. And we're about to go through another one anytime soon. So Bretton Woods in the 70s delinked us from gold as the underlying asset. And in the sort of the 30s and the 40s, we built the petrodollar system. And so this sort of sequence, we're now due another major restructuring debt cycle. And that cycle would potentially now move back to being commodities based. So we see a lot of central banks around the world are buying gold, but there are some outliers now starting to buy Bitcoin, famously El Salvador. But it's not unlikely that the US government does, maybe not build a strategic Bitcoin reserve, but it is one of the largest holders of Bitcoin in the world, since it seized so much of the stuff through the ability to make enforcement actions through the FBI and others. Because it turns out, far from being just a hotbed for criminals in the early days in darknet markets, it's also a really easy way to spot transaction history. Through companies like Chainalysis and TRM Labs, you can actually follow the money on Bitcoin with this perfect record in a way that you never have in the existing financial system. And that is enabling the feds and other law enforcement agencies to very quickly see what looks illicit, what looks like criminal activity. So the complex reality is that the Bitcoin itself is no more of a hotbed of financial crime than any other financial system. It just happens to be one where it's a lot easier to get caught if you do something wrong, or you got to be pretty sophisticated, despite ransomware and what you see from state-sponsored actors. So it's going to be fascinating to watch what happens next. But are you seeing a flood of new companies coming in at the early stage, trying to look more seriously at this now? Is that heating up, or is that still kind of look the same for you and not something you've been looking at? It's still all about AI.
Well, not to make this too much about AI, but going back and fitting Bitcoin into like all the different technological waves, I think what we've built with the internet is technological or digital abundance. What we built with Bitcoin and crypto generally is digital scarcity, which it sounds funny. It's like, you've got abundance, why would you want scarcity? Well, scarcity is what allows you to transact. If you don't have scarcity, there's no way of having a store of value. And now we're also adding digital intelligence. And so now we have three pretty powerful ingredients in terms of, digitizing a lot of what we have happens in the financial ecosystem. There is a lot of activity starting to happen at the stablecoin layer. Are people building new L1 blockchains like, Bitcoin and Ethereum? That's not as much where I'm seeing the activity. It's more the L2 stuff. If you look at, or just improving the L1s, like if you look at the cost of gas on Ethereum, that's collapsed. If you look at some of the new payment networks built on top of Bitcoin, because Bitcoin has gelled in the public consciousness. If you talk to the guy who helped start Libra, which was like the Facebook digital currency, he's like, look, I realized one of the mistakes I made is I probably should just build it on top of Bitcoin, because then it's like objectively independent as opposed to controlled by something else. And it's Bitcoin as one. And so building layers on top of Bitcoin, even if Bitcoin isn't the perfect underlying fundamental, blockchain technology, it's good enough. And it's the thing that's captured the public imagination, which that's, to your point, money is a social construct, even if it's not controlled by the government. People align on certain things being the thing of value. So that, I think, is happening. But stablecoins are the big thing. We've talked about this before, and that's because stablecoins are kind of like blockchain, and they have the public open ledger, but they're much like a sovereign in that they're underlying or just the full faith and credit of the U.S. government. And that's where I'm really starting to see volumes spike. It's basically a new store of value that is connected to a new payment rail that is digitally native, and it has some unique affordances as a result. Those volumes are starting to spike, especially in a lot of different kinds of cross-border transactions. And that's real utility because whereas, we're talking about Bitcoin because the price went through 100K. And so one of the things people love talking about is when price goes up because they want to think about speculation. But the cool thing about stablecoins we mentioned before is speculation is literally off the table. It's like the value is fixed. So it's all about the utility of this new store of value and payment rail. And so that's where I'm seeing probably the most meaningful stuff taking off. Now, for me personally, I focus on pre-seed and seed. And so even the stablecoin, this is like, two people with an idea who are just getting incorporated. Those stablecoin companies are 3-4 years old, a lot of them. Like Bridge, for example, I think is 3 years old. And there's several other of those folks who came out and are starting to see some pretty interesting traction. And so that's the story I'm most excited to see develop. But the Bitcoin 100K story is also one of just broadly acceptance that these things are real, which paves more of the connected bits of infrastructure around the ecosystem.
So the two big narratives in the crypto space have been something sort of agent commerce or using blockchains as an underlying substrate for agents. So there's a ton of projects that have been getting a ton of hype in both the meme coin space and generally projects where crypto meets AI. Because what you've got is, yes, you've got stable coins, you've got the ability to transact anywhere in the world 24/7 for near zero cost on something like a Solana. But the other thing you have is this idea that an agent can have a wallet, and that wallet can have a limited set of instructions about how it's allowed to move money, how it identifies itself, that it is still the same wallet, that it hasn't been, impersonated in any way. So if you want an agent that's going out and booking your flight ticket, one way to do that is with Stripe and software and putting all of those APIs together and building a company to do it. Another thing is to just take the building blocks and have an agent that runs on this sort of infrastructure. Another one is there's a project called Virtual Worlds or Virtual something. And I'll look those guys up and we'll get it on the screen. But this project builds virtual influencers. And some of these influencers now have hundreds of thousands of followers. And of course, this agent gets paid into a crypto wallet, but that payment comes from TikTok and it comes from a whole bunch of other places. So it's fascinating to see stuff that I would probably not consume and feels weird to me, but that is taking off and that has traction. You cannot write off these things by any stretch just because it seems really weird. That's it. The Virtuals protocol. So check these things out, because if they seem weird to you, then you're probably just getting old, or there's a whole bias against these things. If they're successful, then so be it. But in me, there are two wolves. There's definitely crypto is good and crypto is good, but the good but side is reminded of Axie Infinity, right? Axie Infinity, if you don't remember it, was the game that people were playing, but they were being paid to play the game, and it was very popular in the Philippines, and then it largely disappeared, and then it got hacked. And the Ronin wallet hack ended up being by North Korea. That could not be a more bad news story, even though people thought it was the poster child for the metaverse. So these new crypto narratives, usually they're 10 years too early. Because what you're seeing there is probably how things look in 10 years' time, but the projects that are there now, because they're in the crypto world, they're going to have to run this gauntlet of being hacked and all kinds of things going wrong. So I don't know if that's a narrative you've seen and what your perspective is on it.
Yeah, you have to battle harden infrastructure over time at the kind of technology level, but also at all of the stuff on top of that around AML, KYC. And you're right. Every time you have one of these massive price spikes in Bitcoin, it's exciting because it means maybe we're seeing this interesting transition towards a new monetary regime that will allow us to build things we haven't built before, agentic wallets, that sort of thing. But it's also, there's going to be a lot more noise back in the ecosystem. And the noise is not always that exciting because it means some of the real utility can get crowded out or made less visible and you get pushback. But we go through these cycles. And it's good to celebrate the cycle that we're in now.
So here's prediction time for next year. I think the most important thing that the US can have coming out of not just a new SEC chair, but probably out of Congress is going to be the passing of FIT 21, FIT 21. This was a bill that had bipartisan support in the Senate, but didn't pass through the House. Now, the House is pretty close at the moment. I think it's 220 to 215. But there are a lot of Democrats who lean pro-crypto, and there are a few Republicans who lean anti-crypto. And this was just going to do very simply define what is and what is not a security and just kind of give a lot of clear legal definitions to that, which would be hugely helpful, number one. And then number two, I think we're going to see some of the accounting structures around SAB 121 that defined Bitcoin as an intangible asset on the balance sheet pulled back, because there's a lot of companies like SpaceX and Tesla, but also Block, that hold Bitcoin on the balance sheet, and of course famously MicroStrategy, which is a meme stock in its own right. But because you have to record it as a tangible asset, an intangible asset, that dings you on your GAAP accounting measures, and now you suddenly don't look as profitable and as capable as you would be, even though if you just held any other commodity, that would not be the case.
It is a funny rule because it says you hold it at cost, and then if the value goes down, you mark it down. But you can never hold it at above cost, is essentially the rule, in my understanding.
Yeah, if you take just that brilliant, simple explanation, it sounds an awful lot like we don't want you to hold this asset, but we're not going to say why. And I think that's kind of the frustration a lot of the crypto world had, is like, say why. Tell us why. What's the problem? Can we fix it and can we solve it? But also, we're not out of the woods. We're going to see some blow-ups. We're going to see some horrible things. We're just at the beginning of it getting silly. It's only just passing into mainstream consciousness. And it sort of saddens me on some level that I know there's going to be blow-ups. I know people are going to lose money. I know things are going to go wrong, because you can't help but that when the mania starts to kick in, and the mania will start to kick in again. And I really want people to stay safe out there, people. Please never invest things you cannot afford to lose. Please.
Yeah, but we've had a lot of these, tumultuous transition periods, to your point. So if you look at the invention of the joint stock corporation, then you had the South Seas bubble and the tulip bubble. If you look at the transition off of the gold standard, there was a lot of different periods of actually, a lot of populism in presidential elections with William Jennings Bryan over 100 years ago. So that was a tumultuous period. You had hyperinflation in the 70s and Bretton Woods and all of that sort of stuff. And so, yes, these things do happen, but that doesn't mean there isn't important work being done. And if there are blowups in crypto, especially if someone somewhere around the stablecoin thing melts down, it almost certainly will not be one of the companies that is fully audited and all they hold is U.S. Treasuries. It might be someone else, and it's probably going to cast a shadow over everyone else in the ecosystem, which is unfortunate because they're clearly operating very differently. USDC versus a USDT, for example. But look at what happens when we have meltdowns in the financial system today. We had the savings and loans crisis. We had the great financial recession. I'm, a little bit of the view that basically how we design our entire banking system is these aren't the exceptions. This is the rule as to how it evolves, because we have a poorly considered regulatory framework, and actually doing something like the Chicago Plan and narrow banking, which looks and feels more like stablecoins than you might think, is probably a fundamentally safer premise to start from. But I share your concern around, number go up, something blows up, people want to throw away everything, even though you can say, no, look, there are very different actors here approaching this in very different ways.
Yeah, because you all get tarred with the same brush. The thing I said to somebody earlier is most people in crypto hate crypto because, like, you see just this unbelievable potential. This, like, especially somebody who's worked in finance as long as I have, like, just so much amazing stuff you could do with it. But that thing over there keeps ruining the party. And actually, it's ruining the party so much, it's delaying the adoption consistently. But, who knows? Maybe this time it breaks through a little bit. What's different this time, I think, is the institutional adoption. What's different is regulators and policy are now more used to it, and they understand where the risks are. They're a lot more coherent on what the actual issues are. The crypto lobby has actually done a good job on the education side, not just on the policy side, really bringing people up to speed. And whether you're whichever side of the aisle you are, I think there are now people that understand there's real utility here, especially in the financial market side, but also on the global use of the US dollar and stable coins and that sort of space. So it's going to be fascinating next 6 months. But I want to know kind of, as you look at kind of the previous cycles, does anything feel different now and what are your memories of like 2021 compared to now?
I think one thing that's different is the type of noise is definitely different. So we had the whole ICO craze in, I guess it was around 2017, et cetera. I think at this point it's pretty hard to do ICOs. They get a lot of, but like that has moved on. And so now people are more just focused on the things that have stood the test of time. In this case, time being 7 years versus 70 years, 2,000 years, and that's good because you get this reorientation and focus. And so at least one level of the noise is out of the system, and then you have some new things that are happening. Keep saying stable coins, but that is a thing. And then you just, even if you have a technology driven version of finance and money, you still have to have accounting standards, regulatory standards, institutional adoption. There are all these other pieces that have to fall in line, and all of those things are starting to fall in line. And so that's the foundation on which you can start to see real change in how like you and I actually transact.
There's a couple of things that blow people's minds that I use occasionally on the Tokenized podcast, which is available now wherever you get your podcasts, with Kai Sheffield. And the one that I keep repeating to people is there are banks that issue euro-denominated stablecoins. So Societe Generale and Banking Circle have both issued stablecoins in euros, and they're tradable anywhere. Like, you can go buy that on an exchange and send it to any wallet on the Ethereum or the Solana network. I think they support up to like 6 different networks. Why? Because the EU likes to regulate. As Warren G said, regulators are going to regulate. But they did pass something called MiCA. And the MiCA legislation meant that there is a framework for banks to be able to get into stablecoins and to be able to manage a lot of those risks. And so if you see that regulatory certainty come in the US in the next sessions, then expect to see the banks start to come into that space. I know there's a company called Braille started by the Dwolla founder, and what they're trying to do is get the banks into stablecoins as an alternative payment rail, working with some of the smaller community banks. And so I think we will start to see bank balance sheets backing stablecoins more and more, so that not only if you got the stablecoins that have got treasuries, you actually have something that can give you yield. Because in the US, one of the reasons why, if you hold Tether, if you hold USDC, you're not generating any yield from it, is because the SEC was coming at everybody saying that would be a security. We don't want that. So now you've got companies like Circle and Tether holding on to all of these treasuries, giving people, they're not giving the yield because they think they can't, they're going to get sued. So they're just sitting on like 4.8%. And for every dollar that somebody brings to them that they've bought treasuries against. And the people on the front end, the stablecoin holders, not getting any of that yield. They have to go find that somewhere else. So crypto's now built things like Ondo, and even BlackRock has a token that you can buy that institutions can buy that give you the yield against US Treasuries. It's a money market fund, but it's tokenized. It's 100% on chain. So the banks will come, I guess, is my prediction for next year. But prediction time, I got to ask you, where's it going in 2025?
My answer is pretty boring. I think that's related to the question of where do you think Bitcoin is going? Therefore, how much of it should you own? And my answer to that is you should probably own about 1% of your liquid investable net worth. I think that's a very reasonable floor. I think a very reasonable ceiling is about 10% of your liquid investable net worth. And I think you should rebalance into and out of that. So this is me talking in a framework that's more aligned with modern portfolio theory and how you build a diversified portfolio. Nothing here is investment advice than it is saying, whether or not you should own anything. But if you look at modern portfolio theory, even for fairly risky portfolios, they usually have a up to 5% allocation to commodities. So if you want to be like very pro Bitcoin, double that, but going beyond that and you're going into pretty aggressive territory.
You are. I would agree with that. Price-wise, it's always hard to make predictions on where these things end because everybody loves the prediction. It's the ultimate clickbait of like, oh, so-and-so says it's going to hit 1 million and so-and-so says it's going to hit da-da-da. And it literally generates clicks every single time. But I got an email from a law firm friend that I've known for about a decade earlier, who said he remembered in 2016, I said something along the lines of Bitcoin either goes to zero or it goes to $100,000, and it's probably not going to zero. And I'll say today, Bitcoin either goes to zero or it goes to $1 million, but it's probably not going to zero. But that timing is the most important question, because on the way there, it could go to less than 10% of what it's worth now, less than 5% of what it's worth now, and you could lose a lot of paper value if you sell at that point. And so it's an extremely volatile, dangerous thing to do. If you're going to be retiring in the next 30 years, it's still dangerous to be going that space, even if you've got a lot of time in front of you. So that's the caveat here, which is, yeah, it probably is only going one way over like a 100-year time horizon, but you cannot build a portfolio on that. Please do not build a portfolio on it. Exactly as Rex, you said, I think your investable liquid asset portfolio is such an important thing to consider, because if you don't have 3 months of salary in the bank and a rainy day fund, then you should probably start there before you even think about Bitcoin. So, again, not investment advice, just a good waterfall that you would find anywhere on Reddit of what best practice looks like. But the fact that both you and I have this scar tissue where we have to caveat this stuff so hard sort of tells you the dangerous territory you enter as soon as you get near this topic, because we've been near this topic before, and it's just something I want to bring up is
one. I'll tell you something else though. What's cool is, we have prediction markets now, and these prediction markets have contracts around when Bitcoin will cross XYZ price threshold. So you can go to Call Sheet, you can go to Poly Market. And that's something else. We're in this crisis of confidence right now where people don't trust pundits who just say things and have no accountability. Well, you can go and you can look at a market, and Poly Market is built on top of blockchain technology. Call Sheet is a fully regulated exchange in the U.S. for event contracts that won a case against the CFTC, allowing them to trade election contracts, but they would have been able to trade, I assume, Bitcoin price contracts anyways, or predictions about Bitcoin price contracts. And so you can go there and you don't have to listen to the pundits. You can just see what an actual market with people betting dollars says. And so that's a good, if you want to know where it might go, that's going to be the most direct and relevant place to look.
I think on that sort of market narrative thing, something I observe as the Brit looking at the US is that whether you're pro or anti-crypto seems to be drawn down partisan lines quite directly. That is now finally changing, but that's not something you see elsewhere in the world. In Singapore, really quite different. In Hong Kong, really quite different. In the Middle East, very different. It's Australia, very different. This is sort of an apolitical subject everywhere but the US. And I suspect we will now start to get to a stage where it hopefully becomes a little bit more apolitical, but who knows? Because it's very hard to separate that in the US. But I saw Robinhood's also getting into sports betting as well. So the financialization thing is just seeming to be sort of this bigger trend in investments. Is everything is tradable now, and that was sort of happening for a while with sneakers and sneaker marketplaces and collectibles, and that's all kind of still there. Do you see any other things opening up outside of the sports betting and the kind of the prediction markets becoming mainstream? Because I know that wealth space is one you've been close to for some time.
Yeah, I think that opens up another question about where do people go to trade all of these different kind of events, whether sports betting stays with sports betting sites, whether predictions stay with prediction markets, or whether Robinhood somehow figures out a way of being the place you go to for sports betting, for prediction markets, and maybe also, as we talked about with the Trade PMR acquisition, where wealth advisors and RIAs custody their assets and give like sober, well-heeled financial advice. It's like, well, I don't know, maybe. We'll see if that happens.
It's the great rebundling of finance.
Let's not get too far. I think we've got enough on for people to just on Bitcoin.
I just want to leave you with one thought, which is the great rebundling of finance. You probably heard me bring this up before, right? Which is that classic Wells Fargo image where all the startups are attacking all the different things that the consumer finance does. I really do think we're just going to see more and more rebundling as brokerage and stocks and crypto and sort of tax and all of these things start to gradually appear inside of the mainstream neobanking apps and everything else. That's my big watch out for the next 12 months. I really think that's going to be the case. And it's normal for Revolut. It's normal for Nubank. It's normal in Cash App. It's normal in Venmo. But they're just going to keep expanding the range of what they offer, I think, over the next 12 months. Consumer
behaviors are changing. The platforms through which they interact with the financial world, like their mobile phone is changing, maybe through agents one day. The primitives for store of value are changing. The payment rails are changing. And to your point, all those things can come together and mean that you rebundle things in a way that banks aren't well prepared to do. So it's going to be excited. Also, in other news, you should go check your door in about 10 minutes. I've got a dasher coming with a McRib for you.
Excellent. Well, the kids are hungry, so we'll share it.
There you go. I'm here for you.
I appreciate you, man.
All right. Cheers.